Hello everyone, Marty Missouri here with your weekly economic update for the week ending July 29th, 2022. Not going to do a stock market snapshot for you with this video, but I will before the end of the weekend or very early Monday morning, where we'll take a look at the technical setup for the market, the very interesting finish to the week last week, and the prospects going forward, see what odds suggest based on the technicals, at least in the near term. So without further ado, in front of you is our index score, which basically broke even on the week, 2.22, so barely positive. The way we read our index is when we get below zero, we now are in a situation that's either recessionary or odds favor recession over continued expansion in the coming months. GDP, the first estimate for Q2 just came out this last week, and it was a minus 0.6%, which means 2 consecutive quarters of GDP contraction, which is the technical definition of recession, but not the official. The official comes from the National Bureau of Economic Research, so that remains to be seen, although from what I understand, in multiple decades, we have not had 2 back-to-back contracting quarters that did not ultimately get deemed recession after the fact. Now, folks, one thing to keep in mind, the economy is growing on a nominal basis. The GDP is real growth, which makes perfect sense, which means the inflation rate currently is higher than the nominal growth rate of the economy. Looking at interesting developments in the credit market of late, and when we get to the equity markets, as I've drilled into you over the past few years, typically recessions and bear markets are not good combinations, and that's where you get the big drawdowns, like in the tech bubble burst and the mortgage-backed securities burst. However, we do have a Fed that's got new tools and a brand new precedent in terms of the lengths that they will resort to when the economy is contracting. That has the bulls in the stock market pretty aggressive. At least that's the way it looked the last couple of days of last week. What I'll probably show you on the stock market snapshot, though, is the short interest that I've been referencing. Not only did it not decline week over week, it actually got quite aggressively short in terms of the balance of futures traders, speculators in the S&P 500. Meaning they were even significantly more short this last Tuesday. That's the day that they actually record it, and then they don't give it to us till Friday. So I highly suspect that that monster move that we saw, at the end of the week was largely the result of short covering. And also the action among options dealers, particularly those who have sold calls, the hedging they have to do when the market breaks higher, meaning they have to actually buy the underlying security that they're selling the insurance on. So there are positional dynamics that are huge right now in our estimation. And as I didn't mention in the last video, I forgot to, was the largest cash position ever showing up in the Merrill Lynch Mutual Fund Manager Survey, the most recent one for last month. So pretty good setup for a significant bear market rally that may have more room to run, but I'm not sure. I think the risk reward at this point is really getting thin now at these levels, but I'll stop there because that's for the next video. Anyway, fascinating economic/macro setup that we're facing currently. As for the inputs this week, we'll start with the Chicago Fed National Activity Index. 85 data points this last month. 41 were positive, 44 were negative, therefore it broke below zero. That obviously scored a negative for our purposes. Personal consumption expenditures came out. This is the inflation measure. Headline rose to 6.75%. The core, which X's out food and energy, 4.79%. The headline growth month over month, 0.95%. This database doesn't give us the core month over month, but it actually was 0.6%. So inflation does not appear to be abating. However, the trajectory for the second half of June, I think July, you're going to see relatively tame month over month readings. Base effects strongly imply that the year over year numbers for inflation are still going to be pretty elevated. Now, the point about the economy slowing and the two back-to-back negative GDP prints, the last one came out on Friday, and the market rallied quite aggressively on Friday. So folks, clearly bad economic news. The bulls are taking it and running with it. Now, today, Neil Kashkari has to be among, if not the most dovish member of the FOMC, came out and said, essentially, I don't know what the market's thinking or why it reacted the way it did. We have a lot of work to do. This is no joke, this inflation. Those are my words, but this is essentially what he implied. So essentially what he said today to the New York Times is the market's got it wrong for the moment, and we're going to be pretty aggressive. He said a 0.5%. He implied that's virtually a given for the next meeting, 0.75 if they have to. Fed funds futures look like they're discounting 0.5% for the next meeting to 0.25% each for the two subsequent meetings, and then done. And then next year, starting to cut interest rates. The swaps market, the inflation swaps market, however, viewed that as inflationary, as you can see here. The employment cost index, so folks, if there's anything that's sticky, so to speak, that doesn't tend to come down rapidly once it goes up, are employment costs. Right? You raise somebody's wages, you might have slower wage increases in the future, but cutting somebody's wage, that's a tough thing to do. So the employment cost index is at an all-time high at 5.1, just came out this week. So that is a pretty ominous sign about sticky, longer-term inflation at a higher rate than this 2%, I think, fantasy that this Fed is thinking, if it thinks it can get there without forcing a pretty good sized recession. Commodities are coming back a little bit. We've been spending a lot of time on commodities. This, of course, helps our core portfolio, which has a notable position of exposure to commodities. We talked about that whole way. We anticipated a good correction, got more than I expected, I have to be honest. The comeback in the Bloomberg Commodity Index, which is broad-based, you could say is positive relative to the economy. Certainly speaks to, I think, the market thinking that interest rates aren't going to be as aggressive. Therefore, we could see the dollar weaken from here, which would be bullish for commodities, and for lots of reasons that we've talked about and we'll continue to talk about. We're pretty bullish on commodities long-term right here. The raw industrials index, it's coming back up here off the bottom. That would be considered positive in terms of what it says about the economy, but of course it also speaks to inflation. Copper, we spent a lot of time on copper. We are crazy bullish copper long term. I messed around with this chart because I was seeing China as having a major influence. Well, China this evening, actually, PMI data came out. All of it was lower than expected, which says not good things about the Chinese economy. Huge incentive for them to stimulate their economy going forward. They're talking about infrastructure. They freed up capital and lending capacity for infrastructure. Biggest consumers of copper. So I viewed that from the get-go that, once China dispenses with this zero COVID policy and really gets back to stimulating, probably quite bullish for copper going forward. Doesn't look to me at this juncture like we're looking at a deep, protracted recession at this point. Of course, open to that possibility, but right now, in the aftermath of the bullwhip effect and the concerns and the hyping of that phenomenon, which I think is a really good representation of how the economy would work when you get that kind of that COVID shock and stimulus and everything that goes with it. The come down from that can be pretty dramatic from an economic perspective. However, when you balance that against the balance sheet health of the consumer and inflation beginning to come off the boil a bit, doesn't have to be a big, bad, deep recession at this juncture. And it does have interesting market implications. So We do have lower lows staked out for the market, but we're open to all possibilities. So clients, you've seen a fair amount of rotation, lots of hedging action here because this thing could get ugly in a hurry. So we're still approaching the portfolio with caution, allocating to areas that we think make sense over the next 5 years, recognizing that the next 5 months, of course, for example, are the definition of uncertain. I don't think anybody should be playing hero right here. There's lots of factors yet to play out, and we may see another leg lower. We have to stay on our toes and be nimble, of course. I'll leave it there. Thank you, folks, for watching and listening. And again, I'll be back sometime before the market open on Monday with a technical snapshot of stocks. Take care. Bye-bye.